Welcome to Market Insights, informed news and analysis powered by TradeStation. Today's Wednesday, March 28th, and I'm David Russell. Despite all the buzz about a hawkish Fed, interest rates are starting to fall. Yields in the three major Treasury bonds have eased lower after hitting some key long-term levels. Let's start with the 5-year note, which led the run-up in borrowing costs, climbing from about 1.7% to 2.7% since September. It hit an 8-year high on March 21st. The same session, Federal Reserve policymakers raised their key benchmark rate, but the yield dropped the next day and is now down in 4 of the last 5 sessions. That resulted in not only a so-called doji candlestick pattern, but also a potential island reversal. Chart watchers could view both of those events as an indication direction is changing. By the way, type in $FVX.X on the TradeStation platform to view the chart. Then there's a 10-year note, or TNX.X. It's been under pressure for more than a month after stalling near an old high from late 2013. The 30-year bond has followed a similar trajectory. Okay, that was yield, or the interest that investors receive for holding bonds. In case you forgot, yield moves in the opposite direction of price, and we really care about price because that's what we can trade using futures contracts. Our staff of expert instructors created a special indicator that uses highs, lows, and closing prices to suss out whether traders are buying or selling. The indicator shows a potential shift toward buying in the bond futures. Here's a weekly chart of the 10-year futures. Notice how the indicator has turned positive more recently. Also notice how it's holding an old high from April of 2013. Interestingly, stock prices may have anticipated this trend in bonds. Let's fire up TradeStation's ever-useful radar screen tool for more. This time we're looking at how different sectors have performed from the beginning of March through yesterday's close. Utilities and real estate investment trusts have been the strongest, which are usually viewed as safe havens based on their dividends. So, they tend to move in the same direction as bonds. Now that these two parts of the markets are doing well, is that a canary in the coal mine? Especially when so many other industries have taken a beating. Thanks for watching. That's today's Market Insight. Be sure to visit our news feed at tradestation.com/marketinsights for more.